G'day. It's Stefan Angelini from Angel Advisory on the 15th of March, 2023. Here's our daily economic wrap. Let's see what we're talking about today. We will be going through the SVB and how it might affect Aussie banks. Basically, I'll be indicating how the SVB or Silicon Valley Bank is nothing like the Aussie banks. I'll be going through the Aussie house price falls. We just recorded our worst 12 months in history. So I'll take you through what's happened in different suburbs and how much they've all fell by. And finally, I'll talk to you about meta job cuts and how that will be weighing into the global economic picture and global GDP. Now, with people losing jobs, they've got less money, especially in these high-paying jobs like at companies like Facebook, which is Meta. So they've just cut 10,000 jobs, and that's on top of the 11,000 jobs they cut previously. So I'll take you through it all in this last little wrap. Just to let you know that if you want any personal advice, please go and consult a licensed financial advisor, because everything here is just general information. If you want to head over to the podcast or YouTube channel, just look for Real Wealth with Stefan Angelini, and you'll be able to find all our content there. And that's where I'll go through this full episode. Right. So for those of you staying on the line, let's get into it. Basically, there's an article on Market Index talking about whether or not Silicon Valley Bank is a red flag, or the collapse there is a red flag for Aussie banks like CBA, Westpac, ANZ, and NAB. And essentially, it's fair enough to have a bit of a rise out of this, because the S&P Financials Index, the SP/ASX 200 Financials Index, is down by 6.5% in the last 3 trading sessions. That's a fairly decent drop for what is normally quite a secure and lowly and not really volatile index. But basically, one of the big stockbroking firms out there and research firms has said they see no relation between the Silicon Valley Bank and Aussie banks. Here's some of the reasons why. So the Silicon Valley Bank has customers who are very highly concentrated, and they're very lumpy depositors. Whereas our big banks, they have mostly household deposits that make up about 40 to 50% of its deposits across all the major banks. So that's one of the main differential points, is what they're backed by and what they lend out for. The other one is the SVB had a large percentage of their assets held in investment securities, which were out of the money, whereas Australian banks primarily invest in mortgages and corporate debt. Now, if you think of what investment securities are, these are things that are listed on exchanges like bonds and the like. Now, with interest rates increasing, bond prices decrease, so therefore they lost a lot of money there. Whereas when you deposit your money with a bank, they primarily lend out to asset-backed investments. So that is a mortgage, being for a residential mortgage, or corporate debts, lending out to businesses. What the SVB could not lend out to businesses, they simply put into these investment securities. And that's what led to their ultimate demise of not having a good enough balance sheet, losing money on those investments. And of course, when it came time to come up with the money, they couldn't foot the bill. So they're the main differences. Our banks are enormous and have a lot more regulation than the small SVB did as well. So nothing really to worry about there, in my opinion, anyway. Let's look at property prices, and that's one thing that everyone's talking about. Australia has just recorded their largest drop in housing and unit values within the last year, and that's a report coming out from CoreLogic, and this is an article on abc.net.au. Basically, housing and unit prices have dropped by 7.9% in the 12 months to, I think it was to December 2022, or was that to February? Anyway, in the last 12 months. What's happened is there's been 226 suburbs that now have a median price of less than $1 million. But basically, a lot of the suburbs that went through that period of spectacular growth are now going through another spectacular decline. So it seems they've just come off the boil. And this is typical what you see with these high-performing suburbs. You might see some people starting to spruik those suburbs after they've had a tremendous year of returns, but really, things that have a really good run don't tend to always have that run. So that's where your asset allocation and your diligence should really kick in, and not get drawn towards the emotions and the numbers, but really look at the long-term effect of your investment, and don't get emotional, and don't think it's always going to keep going on that tremendous tear. Asset prices, and history shows us and tells us that when an asset is an outperformer in a given year, even if it's a suburb, the next year it probably won't be. So just take that into consideration when you're investing. But basically, sales across the country are down by 21% compared to last year. And that's a report from CoreLogic. Now, let's have a look at different states and what's been happening. So Sydney is down the highest by 13.4%. Melbourne dropped by 9.6%. Hobart fell by 11.6%, Brisbane by 6.8%, and Canberra by 6.7%. So this is the 12 months to February. So just to confirm, 12 months to February. But it's not all bad news for every state, or every major city. So Adelaide is up 5.1%, and Perth up 2.4%, Darwin up 2.9%. So still a lot of demand in these areas, and it's good to see that their asset prices or their property prices have been able to hold up in what is a pretty terrible time for housing prices around the country. Job cuts, especially over in the USA, especially among the big tech firms. Obviously, people have less money, they're spending less, but companies are starting to turn to trying to make more profits. Now, Meta, which is the old Facebook, has just announced that they will be cutting 10,000 jobs. Now, this is on top of the 11,000 jobs they cut recently. So it's basically 13% of its workforce. Is it a massive amount? Not really. It doubled its employee count in 2020. So they've still got a lot of staff, but these are big, I guess, big job cuts. Now, these, I guess, announcements, what they do is it's boosted the share price of Meta. Investors in Meta say there's an issue with the actual profit it makes. Doesn't make enough because employee costs are too high. But when you cut 10,000 jobs and you say you can still perform the way you were performing earlier, just you put less money into research and development. Basically, investors love that. More profit, more dividends, better performing company. It all sort of relates. So that means Meta has performed a little bit better. But what this shows us for the rest of the world is that inflation is having its effect. Increasing interest rates is having its effect. Companies like Meta are being forced to cut jobs, as are a lot of these big tech companies around the world. So with people working less, there'll be less demand on goods. Hopefully, that will drive down the price of goods, and therefore you will see interest rates and inflation starting to come down. So that's a little economic graph for me. Thank you for listening on. If you have any questions, reach out to hello@angeladvisory.com.au, and we'll see you next time. Cheers.